So the first thing about global fixed income, and particularly bond markets in the over-the-counter domain, is they're very opaque. So since the start of 2022, we've traded over 100 billion US of bonds, credit, and CDS. And none of those prices are normally reported anywhere. Or if they are reported, they're reported with a delay, and there's only partial information disclosed. So the OTC market is much like equities before exchanges existed. So the first point is you've got the very opaque nature of this very large and very actively traded OTC market. But then when you look at the participants in OTC bonds, they tend to be very hold to maturity and static in their portfolio composition. So typically active bond managers are actually paid fairly passive fees, and you tend to get portfolios comprising thousands of bonds that are normally held to maturity. A third dimension is the fact that 75% of all the trading volume is actually done by voice in global OTC bonds. So there's very little digitized trading, and that which is done tends to be very small lot orientated and focused towards passive ETFs who are transacting through electronic platforms. And the absence of digitized trading means that it's very hard for straight through processing of trades, which in turn means that OTC credit is largely devoid of quantitative investors, algorithms, and or traditional CTAs. So you bring all that together, what we find is that over-the-counter fixed income is immensely price inefficient. And that means that if you do have a quantitative process, you can develop strategies that have unusually high hit rates. So if you look at our last $10 billion of new issued trades in the OTC bond market, we're typically winning 80 to 90% of the time. We're bringing to bear 60 to 80 proprietary quant valuation models to find those mispricings, but that hit rate is much higher than what you'd find in more efficient, listed and transparent markets like equities or listed derivatives.